So what we're going to do today is give you a little bit of a firm update. We're going to give you a little bit of a market update. We're going to address the three most prevalent questions that we've seen floating around the media, the television, the internet, so on and so forth. And then the two most common questions that we've been getting from clients today. So hopefully you'll leave here not only with some decent food, but some good information. So, and get up and mingle. If you need to get another cocktail or some more food, again, you're our guest. We want you to be comfortable. And we are just honored that you guys are here. And if I don't forget to say this later, it is looking around the room at the people that are in the room and some of the people that we have worked for a long time. It is just an honor to be of service to you guys. So, welcome.
Quick update on the firm. Where we're at now, we're managing about $220 million for 165 families and 7 401k plans. Been in business now over 23 years. And speaking of years, next week, Laura, believe it or not, it had been a year since Laura's joined the team. So time goes fast. I remember sitting here introducing her, like it seemed like that was about a month ago, and that was a year ago. And then Brian and I got to talking about that, just on, we haven't scared her away yet, so hopefully she's going to stick around with us. But, Darlene's been with the team now 15 years, right? And then I've been here, it's over 10 years now. And then Debbie's been here 8, isn't that right? I want to say, started in 2008, great timing. All right, got to enjoy that first year with us. Good timing there.
Now wait a minute, you didn't let me. I mean, I've been trudging at this financial planning stuff.
Oh yeah, I forgot Brian. Yeah. Well, Brian is 23. He started the darn thing, so.
I mean, I was going to say something about getting old. No one in this room really is going to feel too sorry for me, but I was like kind of panicking before the event because I couldn't find any hearing aid batteries that worked in my hearing aids. It used to be I was sitting there like reading what I was going to say, and now I'm looking for my darn hearing aids. But
yeah, get a teleprompter. But I might not be able to see it though either, so that's the other problem. So we were looking at the assets under management when we were getting that number. This is, if we started January 1st of 2008, this kind of stuck out at us, so wanted to cover this. The growth of the firm in assets. This yellow line right here is the net amount invested. So what you put in, and then we sent about $500,000 a month to all of you in checks and income. So right here though, I mean, thank you for sticking with your plan. Thank you for trusting our team at that point. That's tough to look at when that was a trying time. That was a lot to go through. And, by you sticking with your plan, by you trusting our team to, we stuck with our investment philosophy, we implemented it. What we have now, as you see, that's come back, and the difference between the investments and what we've got right now is $42 million in gains. So by everyone, by us being able to do what we do, and you trust us to do that, we've created $42 million in gains since January 1st of 2008. So we appreciate you trusting us to do that. Finally, we just found out recently, we won the Reader's Choice for Top Financial Advisor fourth year in a row. Thank you. We know that's due to all of you. So that's, again, thank you for your time, thank you for support, thank you for going in and voting for us as well as your other favorite local companies. We really appreciate that. We're honored and we can't say that enough.
I just wanted to speak to a few things, and most people in the room know about this, but a few things that we're pretty proud of about the way that we run our firm. And the first one is that we're independent, fee-only fiduciaries, and we feel very strong about that because we just think that the most important thing that a financial advisor can do for a client is to give them solid, objective advice, and to pay attention and to be responsible. And as a fee-only fiduciary, what that means is that we don't accept any compensation from any third party. So I wanted to just remind you guys of this. I know that I just tried to put myself in your shoes as a client, and you see, okay, well, Align always recommends that we go to TD Ameritrade, or that we go to Charles Schwab, or that we use DFA or dimensional funds or Vanguard funds or iShares, and they're all pretty similar. I want to speak to that just a little bit. I want everyone in the room to know, and you may already, but we do not accept 1 penny in compensation from any third party for anything. Schwab doesn't give us a penny for anything. TD Ameritrade does not give us any compensation for steering accounts their way. Dimensional does not send us on fancy trips to Las Vegas like happens at other firms. We don't get golf balls. We don't want, actually I could use a lot of golf balls because I lose a lot of them, but we, none of the funny business that you read about or you hear about at the big brokerage firms goes on at our company. And one of the reasons for that is that as a fiduciary we serve one master, and that is you guys. We don't serve 2 different masters. You are the boss. And it's real something like, the idea of being responsible. Just the other day, a client, had us take a look at something, and there was an investment in his account that really should have been sold a long time ago, and it was, it was a mistake. And I kind of like being able to face the client and say it was our mistake. And in case you guys don't know about our mistakes policy, it is if we commit an error in your account, then we will fix it at our expense, and if it costs you money, we will write a check into the account and make it up. And if our error just happens to have resulted in a profit, you keep the profit. Is there any questions about that?
That's win-win.
Don't you think that's the way it ought to work? But anyway, I was working with this guy the other day, and what happened was it was clearly an error, and he went to the non-fiduciary advisor, and the guy said, well, maybe it'll turn out. Well, that wasn't the answer. It was not going to turn out. And so then he went to his boss, which was not the client. The client's not the boss if you're at a non-fiduciary brokerage firm. So they went to the brokerage firm, and the brokerage firm's response was, well, yeah, maybe you lost somewhere, the difference between this and this, but let's negotiate, and maybe we'll give you a little bit of money. If we commit an error in your account, we're not going to come to you, Claude, and say, well, I see you lost $100,000 and it was my fault. Can we negotiate that? Maybe I'll pay you $30,000. How we doing? So,
One will not be there the next time.
And the other thing about being a fiduciary, it means that we put our money where our mouth is, and that is that we, at all times, not only is it the right thing to do, but we legally have a duty to you to put your interest first in everything that we do in our business relationship. So we don't have to answer to somebody, some big, some middle manager up in Chicago or some hot shot in New York City or St. Louis or wherever. We have to answer to you, and only to you. So that makes it pretty clean, but it's pretty easy for us because we eat our own cooking. We invest in exactly the same investments that we recommend to our clients. So, and I think you know this, but for the record, all of my personal wealth, excluding personal residence, is invested in the exact same investments that each of you own in this room. Now, for the record, my personal investments are 80% stocks and 20% bonds, so that's not exactly what you may own in your portfolio, but in some instances it's pretty close. And so when we eat our own cooking, then we're pretty similarly aligned. And our 401k plan, the Align 401k retirement plan, is the exact same investments that we recommend to clients. And I just can't imagine doing it any other way. It just makes common sense to me. And then finally, most people in the room, or as I look around, you've been clients, or some people in the room have been clients since my son was a baby, and now he's 22 years old and off on his own in LA. But in any event, we stand behind our work with a no questions asked fee refund guarantee for new clients that are coming on board. If and I see a couple of people that just came on board. If for whatever reason you get over here and it's not what you thought and it's just not working out and we're not walking the talk or whatever, anytime within the first year you just let us know. We'll help you move your money somewhere else and we'll refund every penny in fees that you paid to us. So Just a couple of reminders about a little bit of how we operate and how we do business. So, a little bit of a market update. This year it seems like it's been a case of all bad news but pretty decent returns. The markets have bounced around a little bit, nothing out of the ordinary, but let's go ahead and start talking a little bit about what the markets have done this year. Dennis, I guess you're going to go back and kind of walk through from January
we'll just do
on.
a quick look on what's happened so far this year. And a lot of you know that it started off pretty rocky, of course. We had the concerns of the growth in China. Oil really took a hit, started a big decline. So with all that, we had a quick 10% pullback in about a 3-week time frame there. And then right after that, we saw a 17% increase in U.S. and international didn't recover near as much, but it did recover as well. And then we hit the whole Brexit deal where we saw some more volatility. So there's quite a bit of volatility. It rebounded. A lot of what we're going to cover today is what did we do when this was happening? What were we looking at? Why did we do that? But like Brian said, this really isn't anything out of the ordinary as far as volatility.
And I think it is important to be successful in anything that you just accept reality. And the reality is, even though we had a pretty significant decline there in the second and third week of January, it was about 10-11% depending on the market that you're looking at. But what this chart shows is that those kinds of declines are just, they're as common as dirt. They happen all the time. And this goes back over the past 36 years. And it's kind of amazing because you look and you see what's happened over the past, 36 years. On average, get this, on average, the S&P 500, the U.S. stock market, on an intra-year basis, it has had a decline on average for the past 36 years of 14.2% to the downside. And if you just let that kind of sit for a little bit, I mean, a 14% decline, seems like a big deal, but it's a once-a-year occurrence. It happens all the time, so it's nothing to get totally concerned about. Now, I look around the room, and I don't know anyone in the room that's 100% in stocks. So if you're 50-50 stocks and bonds, that means that you really need to be prepared, for a 7% decline. It happens all the time. If you're 100% in stocks, you need to be prepared for a 14% decline on it. But the good news is that the declines are temporary, the advances are permanent. And if you stick with the plan, you believe in a plan, and you see that the plan supports your financial goals, and hopefully that's what that chart that Dennis went over earlier said. It said that to me. It said that, you guys believe in your plan, and we don't take this lightly, that you believe and you trust in us, and we appreciate that, and we take that very seriously, and we try to uphold it. But these kinds of declines are very normal, and they're going to happen again. I don't know when they're going to happen, and they typically happen, even though these are annualized returns up here. One of the points that I want to make, and we'll hit it several times, is that markets, you've seen all the charts in our office and in any financial advisor's office that'll talk about annualized rates of return. Well, it'll say, even up here, it'll say, it actually doesn't say it on this chart, but stocks for 100 years have done 10%. And small company stocks have done 12%. And corporate bonds have done 6%, and government bonds have done 5%. We've all seen those. But that's not the way it happens. All the returns happen in just a handful of days. So, the markets are up about, between 7 and 15%. We'll go over depending on the asset class that we're talking about. But you've noticed that if you're in stocks, unlike the chart that you saw at Merrill Lynch and it said 10% a year, it doesn't happen that way. It doesn't come in nice, pretty boxes. It goes boom, 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 and it happens really quick. And then the downside happens really, really quick. But if you miss it, you miss it. There's no rewind. And so that's why it's so important to develop an asset allocation that you think is really right for you, that supports your financial plan and your financial goals and your dollars and your deadlines, and then stick to that and sort of let us do our job when we're rebalancing and keeping that plan on track. Now, things happen, and you may change things may happen where your whole life changes, and therefore it's logical to change that plan. And we never forget that it's your money. You can always change the plan, but but to work the plan and know that you're in the right mix of stocks, bonds, U.S., international, so on and so forth is really kind of I think the key to being able to consistently earn some, good solid returns over the long term.
Yeah, so as you saw there, volatility is always going to be here. It's always been there. It'll be there going forward. This shows you really what we can do is we can solve that volatility with time, which if you think about the way we do planning with you, that's really what we're working on all the time. Is you look at the blue here is days in positive returns, the black is negative. Going back to 1988 through June of 2016, daily, it's 50-50 chance. That's why you don't hear about day trading anymore. It's 50-50 shot. No one made money doing that, that's why. Then you get monthly, quarterly, annually, it's about an 80-20. So, you think about if you look at these percentages and our conversations on, okay, when are you going to need this money? Come in and what do we do with it? When are you going to need it? Because if you need it in a year, there's a 20% chance we're going to have to sell those stocks at a loss if we do that. We're not going to do that. But if we give it 5 years, now we've got about a 17% chance. We're getting there a little bit. And really the difference, it may not look like a lot, but that annual, that 20% chance of a decline maybe is about 10% if you've got like a 60-40 mix of stocks and bonds. That might be a 10% decline. It's pretty good chance it could be there. But on that 5th year, it's still about a 20% chance, but that might be about a 2% decline if we go through and back test this 40, 50 years. So it's not too bad. And then we get into 10 years, now it's 10%, and it's going to be, again, 1%. But we get into 15 years, it's never happened. And so when you look at how we do the cash flow, we say, okay, we've got 2 years in cash, we've got maybe 12 years in bonds. Well, now we're right here. For that stock portion, we don't have to worry about where the stocks are today. We don't have to worry about Brexit or Grexit or oil and things like that. We're not going to touch it for 15 years. And we've never had to worry about having to sell a loss with that. So it solves it with time.
Okay, little market update. So what we have up at the top here are the index returns of the primary asset classes that we use in the portfolios. I know that in many of your portfolios we'll have 10 to 14 different asset classes, but these are the big ones. This is where we have most of the money. So U.S. stock market, it's been nothing but bad news and political drama and Brexit and so on and so forth. U.S. stocks, and these are all these numbers are as of just a couple days ago. Up 739, and then our largest holding in U.S. stocks has done 825. International stocks, Europe's had a little bit of a struggle with the British voting to leave the European Union. The asset class down 1.8. Our investment in that asset class up slightly. Emerging markets, thank you guys so much for bearing with us. I know that we've been, saying hang tight. Claude and I have been calling these submerging markets for too many years. Anyway, one of the best performing asset classes, and DFA's done a really good job there, put some really nice numbers on the board for us at 14% there in emerging markets. Who'd have thunk it? They're talking about interest rates being low and everything, and interest sensitive asset classes like real estate probably not doing so good. Well, let's not try to forecast too much and predict. These gurus are often wrong. Who will take 15% each year? Oh, I'm sorry, we're only halfway through the year. Could be 30. Intermediate term bonds, 4%. We're a little shorter in high quality, so we didn't capture all that. We're at 315. Did my clicker? Oh, there we go. And then our newest asset class, long-term treasuries, up real nicely at 12%, and the investment that we chose to implement that asset class did even better than that. So overall, it's been kind of a bad news year, but good for the markets. So anyway, pretty decent returns, I think, so far this year.
All right, next thing are the 3 things we hear from the media. Of course, we hear a lot more than 3 things. We hear that every 5 minutes probably. But what we're going to focus on are really the 3 main headlines that you see that's really stuck out that we've consistently heard throughout this first half of the year. And of course, the first one, we've got up here, fact or fiction. We're out of the woods with Europe. We're sitting here last year talking about Greece. And this year we're talking about the Brexit. And, just in general, Europe's got some concerns about their growth going forward, their economy. But the market's rebounded. So are we out of the woods yet?
So this is a chart, or this is our map of the world that we nerds, this is how we look at the world. I mean, I know you've not seen a globe that looks like that before, but so this is a map of the world not in geography or landmass, but rather by where the money is. That is the relative market capitalization of every country in the world. And big brush is the United States represents 52% of the world's market capitalization, and then everything else is outside of the United States. Do you remember what we were talking about? You remember, don't you?
This time last year.
This time last year, it was this. Where do they get these terms? The media comes up with, it was Grexit. Remember Grexit? But I mean, they come with stuff like Grexit, Y2K, the dreaded fiscal cliff. But I'm going off on, but I don't even know where they come up with these words. They just kind of make them up, these scary words. But in any event, you remember when we were like, hey, really, are we that concerned about Greece? Because this is Greece right here. See that little speck? And if you really think about it, the media was saying, okay, Greece is going to default on their bonds. Okay, well, first of all, they've defaulted on their bonds many times over the past few centuries. I mean, they've always been broke, all right? But aside from that, if they did default on their bonds, the media was saying that it was going to drag the entire global financial markets down with it. I mean, really, use your common sense. Is that possible? But it sells a lot of magazines, sells a lot of advertising, big money in advertising, right? So if we turn to the latest event, and this is more substantial. I don't want to downplay and I don't want to be a Pollyanna. When Britain voted to leave the European Union, they're 7% of the world's market capitalization. So it's a much bigger thing, and it did come as a surprise. That's why we saw quite a bit of market volatility to it. I mean, I don't really think it came as much as of a surprise to most people, at least in our business, that Greece was once again going to default on their debt. I mean, they've been doing that for centuries. But this vote by the Brits saying we're going to leave the European Union, that was the first major country that ever decided that they would say, I'm going to get out of this arranged marriage and we're going to go back and do our own deal with our own laws and our own judges. And all. So that was surprising news. And in case you haven't sort of figured it out, that's really the only thing that moves markets is surprising news. Unsurprising things like Greece defaulting on their debt for the 18th time in the past 1,000 years, that's not all that surprising. So if it's already out there, it's probably embedded in prices. But in any event, what happened on June 23rd when the British voted that they were going to leave the European Union, the exit is not over with. They have not exited. Nothing really has happened yet. I mean, David Cameron said, okay, if you guys are going to do that, I'm going to resign. So they got to get themselves some new leadership. But this started a 2-year time frame with all sorts of rules and laws and regulations that are designed to ensure a smooth exit of the British or any other exiting country from the European Union. So this story has yet to be written. There's lots more that could happen, but there are a lot of rules that everybody is supposed to abide by to ensure that it's going to be not chaotic, but smooth on the way out. That's really all I have to say about that. I don't think that most people know how this is going to turn out. Many people say that this is an absolute disaster, but who knows? This might actually turn out to be a good thing. I don't think that anyone can really predict how this is going to turn out over the short or the long run. But what we do know is that it's still, even though it's more significant than Greece, we go from Grexit to Brexit, but it's still only 7% of the world's market capitalization. So, what does that mean? What does that mean to you? It means that for whatever amount of money that we are handling for you, take a look at the fact that maybe we have 50% of your money or 40% of your money in stocks. All right? Now, out of that 40% of your money that we have in stocks, 7% of that 40% is in UK companies. and we have virtually zero exposure to UK bonds. And so I think that I can safely say that even if Brexit turns out to be the disaster that the media has made it out to be, I really don't believe, we just don't have that much exposure to it, and I don't believe that it's going to be disastrous for anyone in this room. We're too diversified. It's not going to derail anyone's plan. Now, am I saying that if things go a lot worse than expected with the exit, that your account may decline? No, I'm not saying that. That could happen. I'm not saying that's probable, but I want to leave that open as a possibility. The story is yet to be written, and it is something we're monitoring it, and we will stay on top of it. So,
anyone want to guess where the arrow is going to point to next year?
What?
Said, anyone want to guess where the arrow is going to point to next year? Have a third one next year? It'll be one of these other countries somewhere. We'll have to point the arrow again. We'll keep track of all these and move the arrows around. All right, the second point. So fact or fiction again. Rising interest rates will spell disaster for markets. So before we even get into that, how many years in a row has this been the headline? I mean, it's been like, 7 years? It's every year. Next year's going to be the year. And it's been, everyone's been worried about rising rates. Well, then in December, it happened last year. So the Fed raised rates for the first time since 2006. And so, man, it really hit. Now they're telling us when it's going to happen, how much it's going to happen. It's going to happen this month, and here's how much to raise it. And then 3 months later, they're going to raise it this amount, and it had it all planned out, and here's what's going to happen in the market. It's going to get out of stocks, get out of bonds. This is going to be terrible. So what actually happened? So this blue line right here is what happened to bonds. Black line stocks, which we've kind of gone over. The year starts and we have that big downturn. So investors flock out. They do the wrong thing at the wrong time. They go sell at the bottom, put all their money in bonds. So bonds rose, did pretty well. Then it gets up. Fed says, no, we're not going to raise rates after all. Bonds go up a little bit more. They haven't done anything since then. And then we hit Brexit. Bonds go up a little bit more. Now we're sitting, they've made, we saw 3, 4, 5. We've had some that done 16% this year. Bonds have had a great year. So, they were spelling all out on why it was going to be terrible. They've done great. And we still have a positive return in stocks. So it hadn't happened, but that still really doesn't answer the question. I mean, it's going to happen eventually. We just don't know when. I mean, that's obvious since, like I said before, we're positive it's going to happen next year. It still didn't happen. But when it does, instead of trying to guess and say, here's what's going to happen and what's going to happen, well, let's just look at the past 5 periods when it has happened. What happened to stocks? What happened to bonds? So you see here the last 5 periods where the Fed has raised rates, only 1 out of the 5 times have bonds actually had a decline, 3%. That's okay. We'll take that. I mean, it can't always do well, but even more surprising maybe is stocks always had a positive return every time, averaged 8.5%. I'll take 8.5%. I mean, you don't see really any reason to time this. People timed it and got out based on all these guesses. You missed out. And even, why do that? Why even try? You're going to get positive returns based on the past 5 periods.
I might make one other point about that because I can remember in 1994. Unfortunately, I was in the business back then, and I know you guys were investing as well. But the Fed raised rates back in 1994 6 times, and they'd never done that within a 12-month period of time before. And it was not a situation like we have today, where probably. I hate to put. How long all I'm trying to say is, again, only surprising news dramatically moves markets. I mean, in this, how long have we been talking about, well, the rates can't go any lower, they've got to raise rates. We've been talking about this, as Dennis said, 6, 7, 8, 9, 10 years. That was not the case back here. When the Fed raised rates 6 times in 1 year, it was like boom, 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 boom. It was like it just hammered the bond market. Well, let me just see a show of hands. If the Fed raises rates, or when the Fed raises rates next time, who is going to be shocked by that? Is anyone in the room going to be surprised by that? I mean, who doesn't know this? So if it's not going to be surprising, then I'm not saying it's not going to be negative. It may in fact be negative, but I don't think it'll be this surprisingly, whoa, we didn't expect it to be that bad. And I don't know that it'll be worse than expected. And so, it's just really important to keep in mind that, only surprising news moves markets, and really it's all about expectations. So if news of any kind comes out, like a raising of rates, it's only if it's worse than expected. So if the Fed is expected to raise rates by 1/4 point, let's say, and then Janet Yellen just decides, well, I'm going to show these guys how tough I am, and she raises rates 2 percentage points, rather, that would be
6 times.
Yeah.
That would be surprising.
That would be surprising. So, in any event, I just thought I'd throw that in there. Okay, we're going to talk a little bit about, this has been dramatic. Where's Russ? Russ McClintock, where are you? You promised. And I would like to extract a promise from everyone in the room, or else we'll just skip this whole section. Talking about politics, especially this year, gets people's blood boiling, mine included. I don't think that that's going to serve for a very productive rest of this meeting if we turn this into like a, you know what I'm saying? This is not a political rally. All we want to do is, look at fact versus fiction and determine, okay, how is this election or any other election likely to affect your investment accounts and your money based on what's happened for a very long period of time. All right, so if we can I get, please, Claude? Hey, if we want to talk politics, well, let's take it offline maybe when we finish. I'm happy to do it all night long. But if we can stick to the facts or the fiction idea of the program, I would really just greatly appreciate it. And I think it'd be more productive for everybody in the room. Okay, so fact or fiction? The presidential election is going to have a major effect on markets. Well, we think that's primarily fiction. And we'll kind of go over some of the facts, but let's just go to the first.
Well, and before I go to the next slide, too, we hear this often in election years. It's, well, I'm going to wait until the election's done because it's going to go down, or it's an election year and the market's going to go down.
Or it's going to go up.
Yeah, or it's going to go up because of it, yeah. So if you look back, since 1920, using the U.S. stock market, it's been up 68% of the time annually. If you just take out the 23 years, the election years in that same time frame, they're up 67% of the time. It's exactly the same. So there's really nothing to show just based on its election year it's going to change anything. However, this might be surprising to some. What the data does show is who wins might have a factor on it, on returns. That number might be surprising. That's a simple kind of show you, just don't take everything at face value. There's more to this. Brian's going to go over that in a minute on how those returns came out. What are we saying here, though? So here's the deal is there's no commander-in-chief of financial markets. And if you really think about it, the iPhone is more important than who the president is. And here's why.
Wait, what did you just say?
The iPhone has more effect on the markets than who the president is. Okay? Do what? Yeah, this thing in your pocket. Most people's pocket, which is why it's pretty important. So here's what I mean. In 2014, Apple accounted for 20% of the returns of the S&P 500. One company. The iPhone is 70% of the revenue of Apple. So Apple had more impact on the return of the S&P 500 than most companies in it and really anything else. But here's what I really want you to think about, though. How long has the iPhone been out? 9 years. So if someone's sitting here 10 years ago, you saw the gurus on TV trying to predict what's going to happen in the next 10 years, you're trying to predict something based on what has the largest impact. It's not even invented yet. That's why you can't really predict what's going to happen over the next 5-10 years.
They just sold 1 billion iPhones.
No what?
They just sold 1 billion iPhones.
Yeah. I mean, think about that. It wasn't around 10 years ago, and essentially that one product, the iPod, iPad, iPhone, accounts for 20% of the return of the S&P 500. It's pretty crazy.
So what we did here is we just tried to gather from all sorts of places as much data as we could about how could the election affect the financial markets and hence your investment accounts. And so the way that this is set up, we went back to the end of World War II, so it goes back some, I think, 71 years. And we ran it and we said, okay, what if there's a Republican president, Republican Senate, Democrat House? So it's going to go President, Senate, House. And you look at all these different iterations and looking at the data, and we had this spreadsheet. Somebody could make an argument that obviously if we're Democrat, Republican, that's optimal, or if Hillary wins, then that's what this means, or if Donald Trump wins, that's what this means, or if Republicans win. You can make an argument either way, but we just tried to look at it from all sides. And one of the things that you may have noticed over the years is that long-term averages, things tend to regress to the mean. I mean, that's, not only, that's one of the things that we have been kind of relying on when we've been talking to you about, hang in there, Claude O'Barr. I know you don't like these emerging markets. I know they've been submerging, but they're priced so low, and things tend to regress to the mean, and over the long term, emerging markets have actually done a little bit better on much more of a bumpy, but it'll regress back to the mean. And so if we look at this, one of the things I would bring our attention to is the average return over the past 71 years has been 12.8%. Now, when there was a Republican president, it was 10%. I don't know why, and I'm not going to, make any claims about Democrat or Republicans, but this really surprised me. When it was a Democratic president, it was 15%. There was all sorts of iterations in here. In any presidential election year, like this year, it was 9.9%. By the way, this big negative here, this was back in 2001 and 2002. Lest we forget, many Americans were lost that year in the World Trade Center and all the fallout from that. Could this happen again? God knows we kill each other too much these days, so it could happen again. I mean, I just don't know, but I think this might be an anomaly. But look, if we go back to some of these long-term things, who'd be okay with this is going to be just an average election year and we clock off at 9.9%? I mean, I'd be okay with that. If it's just an average year over the past 71 years, it'd be 12.6%. The takeaway from all this is that I think if you look at this, it goes back to World War II. It's 71 years. It is full of Republicans. It's full of Democrats. It's full of peace times. It's full of war times. It's full of booms. We had the technology rage where everyone, all you had to do was put money in something that ended, the name ended in .com, and you made 80% in that thing. We had I can remember back to that, the Munder Net Fund and the Janus, Triton high technology thingamajigger that did like 126%, and our Boeing stuff did only 35%. How could you? But it's a very long, extremely varied, and therefore perhaps pretty meaningful data set. And I just don't think we can draw any conclusion about if Trump wins, this is what happens. If Hillary wins, this is. I know that they will have dramatically different policies on everything from health care to tax, so on and so forth. But here's the long-term data, and the averages, between 9.9 and 12.6%. Not saying that's what will happen, but long-term averages, that seems to be what is at least possible. Looking at the choices on the candidates, you may be sitting there saying, well, Brian's obviously not paying attention to the debates. It's nothing but ugly, but those are the long-term averages. I would not let the drama of this year's very dramatic election derail your financial plan, is all I'm really trying to say with this chart.
And that brings up a good point, too, with you just saying that. I mean, that's a 71-year time frame at 12.6%. Was every president great during that 71-year period?
Yeah, even if you believe that they are awful options, like somebody in the room said in my ear when they walked in, I mean, maybe there were some awful options here. I mean, we had some people impeached, almost impeached. Say what?
No political statement. All right, the next thing.
Before we go to the next topic, I do want to thank everybody in the room for not getting too. No one got very fired up about that. I can tell that Claude is going to corner me at the end. But.
No one broke their glass or anything like that. So on to maybe a little more fun topic here. The next thing is two things we hear from clients. Again, we hear more than two things. But these are two things we've heard pretty often over the past 6 months. The first one is, why are you selling what's going up and buying what's going down? And so we've heard from a few of you in here, we've heard that, and I imagine there's a lot more of you in this room who have thought it, just haven't called us and asked us why in the heck we're doing that. And the next thing is, why is my wife's IRA or my husband's IRA doing a lot better than mine? What's up with that? Why do you like him better than me? So we're going to cover those two things here.
Yeah, that's actually happening. Those of you that have worked with me for very long know that I'm really way deep. I mean, I get really bogged down in details, and sometimes, many times, language is very important. But this idea of, well, obviously this is going up, and obviously this is going down. I read it in the magazines, I hear it from people, I hear it from clients, it's almost we can't help it. But just think about the languaging that we're using there. What is in fact going up? Going up. I would submit that we don't know what's going up, we don't know what's going down. There is no shame in this. Nobody else knows how to predict the future either. All we know is what's gone down and what's gone up. And so that's our firm belief. We believe that in our bones. No one can tell us what's going up or going down. So it's not like we are intentionally, going and getting into something that's going down. I mean, who wants to do that? That's insane. But the other thing that we wanted to point out with this little exercise is, and we talk about it all the time, but the media, it's important to remember that the media is in the business of selling advertising. They are not in the business of giving us good, solid financial advice, and they're certainly not in the business of giving good, solid financial advice that's customized to your particular situation, concerns, who you love, who you're trying to help, your tax situation. So a couple things I'll point out on this. So this was January the 15th, 2016. This is when the news came out that China's economy is really slowing down. It's going to affect everything else. And not to mention, there's several people in the room that know very painfully where oil prices were and still are. But in any event, those were some of the things that were going on. This came from this reputable magazine called Forbes. I want you to remember that when we, Dennis is going to share a quote with us from Steve Forbes, who owns that magazine. And then I also want you to look at the languaging here, how to protect yourself from the coming bear market. And remember those words, because we're going to look at a quote from a pretty successful investor named Peter Lynch when he addresses this idea of getting ready for the next bear market. So we go to the next headline, which was just like 5 days later, I think.
Oh, sorry.
You're falling asleep on me, Dennis. So here's another reputable magazine, U.S. News. And this is just a killer. I mean, it's the Dow drops 500 points. And then it goes on to, I don't know where they're going here, as international stocks. Okay, the Dow are 30 big U.S.-based companies. I'm not sure really what that has to do with international stocks. But in any event, that doesn't make a lot of sense to me. What does make sense to me is it's real clear what's going on here. And what's really clear about what's going on here, and it happens all the time, and the lower the quality the media source, the more brazen these statements get. You've probably gotten on some of these newsletter things that talks about the end of the world and the 60-minute long thing about how everything is going to go to zero. And I think one of their newsletters is like the guns, butter, and money, or hell, I don't even know what they call it, but it's like, it's going to be the end of the world, and then it's not the end of the world, and they make up another end of the world. But think about this: the Dow drops 500 points. Now that sounds big, doesn't it? That was big when the Dow was 1,000. That'd be a 50% drop. That'd be a pretty significant drop in a day, right? That would be newsworthy. Now when the Dow was at 5,000, which really wasn't all that long ago, that'd be a 10% drop. Today, 500 points, I think the Dow closed at 16,480 or something like that. Let's call it 16.5. That's like a 2.7% drop. Okay. The Dow moves on average, 0.8, 0.9%. It just bounces around about at 1% a day. That's the way it works. Have you noticed that that's the way it works? So how newsworthy is it that the Dow dropped 500 points? That's just an average 3 days. Who cares? I mean, it's just crazy. It's just fear-mongering. And then we go over here to the New Yorker. Oh, we're already in a bear market. Well, no one can say for sure. Okay. But I do think it's clear, as of right now, we looked at the returns. Are we in a bear market? Doesn't look like we're in a bear market to me. So I thought that that's pretty good. I'm not big into quotes in some of these things, but again, that newsletter, far more money has been lost preparing for the next bear market than in all the bear markets. You just lose so much opportunity if you succumb to all this fear and fear-mongering that you don't get anywhere.
So the next one is, we've sat up here and talked about this quite a bit, and how the media's showing you this, they're not your friend, they're not helping you out. We came across this data, we had to share this. What this is, you'll see here, this blue line is the S&P 500 from, when was it, back in 2004 to the June of 2014. This red or orange line or whatever it is the viewership of CNBC in that same time frame. What do you think they want to happen? I mean, like Brian said, how do they make money? The more money, the more people that watch, the more they charge for advertising, the more people that want to come on there, because I think we've told you before, everyone that's on CNBC, all the the guests on there, they pay to be on there. You can pay to go on there and talk about whatever you want, and more advertising dollars. And I was actually at a financial planning conference earlier this spring. Anyone heard of Bob Dahl? He's always on there. He was like the chief investment officer of BlackRock and Merrill Lynch, and he's at Nuveen now. So he's talking at this event, and he's talking about, it's kind of funny that he's on the meeting, he's telling you not to listen to it, but he said every time I go there and they're kind of prepping me and putting all the makeup on and everything, they'll come in and say, now remember, you're here to entertain. We're entertainment, not education. So entertain them. Don't worry about educating, just make it something exciting, come up with it, and you got 5 minutes, or whatever it is. He said every time they remind him that. So this, I mean, of course you see, 2008, it spikes way up. Spikes up again right here. That's the U.S. debt downgrade. Comes up a little bit again there. There's the fiscal cliff. They love stuff like that. That's why they're always on there telling you how bad it is. Here's what you need to do. If you came in, right here, and the market's falling, they're saying, don't worry about it. Just stay with your plan. Stay as is. They're not going to have that spike in viewership. So, that's TV. Do you think newspapers, magazines, they're the same way, right? I mean, if they just put that on the front of Money Magazine, just stick with your plan and don't worry about reading this magazine, no one's going to pick it up. They're going to put all these headlines on there.
Before you go forward, Virginia, you were so kind to take me to listen to Jane Bryant Quinn a number of years ago. And many people know who Jane Bryant, she was very, very objective, very smart, very consumer-oriented. Jane Bryant Quinn calls this stuff financial pornography.
So as we showed earlier, we had a headline from Forbes. It's talking about, how to prepare for the coming bear market. So here's what Steve says about their magazine. And he admits it right there. That's what it's all about. That's how they make money. And they're good at it. That's the bad thing. They make you pick it up and read it.
I think he was going to be president at one time, wasn't he?
He was, yeah. People didn't have a short enough memory, I guess. Okay, but that really doesn't answer, and we're talking about why. Why did we sell that? Why did we buy this? So let's get into why we did that.
So it does bring up the importance of our rebalancing process. And the idea with our rebalancing process is we create a financial plan for everybody, and then we'll have a target stock bond mix, and then we'll have a target, how much do we have in U.S. versus international, and how much do we have in all these different asset classes. And then we monitor these portfolios every day. But what happens is one portfolio, for instance, global REITs. I never would have thought that they would have done 15%, halfway through the year, but they did. And so they shot the lights out, and when that happens, we'll take some of that, we'll take some of this global REIT money off of the table, and we'll go buy something, that has done worse than expected. For instance, this year it's been developed market or European stocks. Okay, so the whole idea is, it's really the whole idea of most investing, I think, is to buy low and sell high. And so our process is just a continual, gradual sell high, buy low, sell high, buy low, sell high, buy low. Boring, boring, but effective. Boring, boring, but effective.
Yeah, so we've gone over this a few times. I know a lot of you have seen this quite a bit. This was a great year. We decided, we'll go over it, but let's show some real-world examples. You saw, we got the phone call, so we know we saw the trade. Why are you doing this? So we just want to give you a few examples of
yeah, so a lot of times, I'm not going to pick on any individuals in the room, but it was like, well, why did you sell that? That's the only thing that's going up, and you bought that, and that's going down.
What are you guys thinking?
Well, yeah, have you lost your minds over there?
So here's one. Now, this didn't happen in every single portfolio. A good portion of them was this first one. Here's what I said, remember the day when those headlines, the coming bear market? That day right there, right on the bottom. And it just happened to be the day that with our portfolio management system, we monitor these accounts every day. Do we need to rebalance? Is something out of whack? A bunch of them hit this day right here. And so what we did is we said, our stock portion has gone down considerably. They've gone down 10, 11% there. So we went and bought U.S. and international stocks that day. And how did we do that? We went and sold the bonds that had done well up to that point. Back to the bonds weren't supposed to do well. That's
I hate to interrupt. Wait, Dennis. I hate to interrupt, but you bought here, but it was going
down.
Down. It was going to go to zero, wasn't it?
Yeah. And these were going up. Oh. You see, and honestly, we didn't know that was the day. That's lucky. It just happened to be, there's that 10, we give a 10 or 20% band based upon what kind of account it is. That was 10%. It hit the trigger. So we did a lot of trades. We did some other ones about right here. All right, so then we see what happens though. U.S. and international markets, U.S. does quite a bit better. This goes up through May. So we're clocking along.
Wait, Dennis, I want to go back. I'm sorry. Did we know this? Did we know that this was going to be near the bottom? Obviously we didn't, or we would have been able to pick this, right? And did we know that this would happen right away? No. It could have stayed down here for a long time. I assure you that it was not going to go to zero. Not when we own, 4,000 stocks in that asset. They're not all going to go to broke.
And that's the advantage of buying the whole market. We know it's not going to go to zero. We're not buying two stocks. We're buying the whole market. We know they'll come back. So they do. They continue to come back. So that goes from there. Now we're hitting June, about right here. Well, now they've gone up 17%. It's on the flip side now. It's done a lot better than we expected, a lot quicker than we expected. So we're sitting right here. So here we sold some U.S. stocks because they had done well. I'm going to put it right back in those bonds. They hadn't gone up as much. Here's the thing I want to point out, though. So that's part of our system, and we're doing that. It does help. You saw that helped increase returns right there. But here's where it gets real important, though, and why we do this. So you see right here, the market's doing pretty well. This is Brexit right here. If we don't rebalance right there, let's say we did that rebalance back in January and you're in a 60-40. We rebalance, get you 60% stocks, 40% bonds. Market runs up 17%, we're sitting there, and now you're at 70% stocks, 30% bonds. We're like, that's okay, let's leave it. we're just going to abandon the plan because we think it's going up, right? So why make a change? Yeah, why do anything different? Well, if we don't do that, then this decline right here is going to be a lot larger than what we've discussed. We're about managing that money for the downside. And that's really what that's about right there. So if we rebalance back, we bought some more bonds, and then that volatility happened, you have that decline right there with the stocks that we've discussed, that we know you're comfortable with, that we've talked about. And if we don't make that trade, it's going to be a lot worse. And so that's really what that's about. It's great, it helps the return, but it's really managing that risk and making sure we're always taking the right amount of risk and reward in your portfolio for you.
Okay, let's talk about this question. I realize that we're about 12 minutes over, so we're going to speed up if you can help me, Dennis. This has happened many times. Why is my wife's IRA doing better than my IRA, or vice versa? And we got a call, just
Last week.
Last week or this week?
It was last week. I don't know.
Last week, super guy. And super smart guy. He's he's a great physician, and he never calls unless he's got something important to talk with us about. He runs around to like 6 offices, and he's, guys, I really trust what you're doing and everything, but why is my wife's IRA doing so much better than mine? She won't even come and see you guys, and I come and shoot the breeze with you all the time. Why would you favor her? And so
he actually said, are you trying to get her to come in and talk with you?
And I knew this is what it was. I knew it was all this nerdy tax allocation stuff and all this. But, Dennis and I were like, well, let's pull it up. And so we pulled it up, and the wife's IRA, sure enough, man, it had shot the lights out because what we had. So here's the thing. If we are working with a family, we're working with that family unit. And if it's a happily married couple, and that's real important. You may laugh about that, but this does not work with unhappily married couples. And it does not work with, kids that have left the nest and they're going to go do their own thing with their own money on their own time frame, but it works with happily married couples, okay? And the idea is, so we live in a world of taxation. I'm not going to get too detailed about it, but we can invest in taxable accounts, like a trust account or a joint account or individual account. We can have tax-deferred accounts, like a 401k account or an IRA. We can have tax-free accounts, like a Roth IRA, right? So if we understand that, does it really make sense to invest exactly the same way in each one of those accounts and just duplicate the portfolio over and over again? We think not. It would make no sense to own, for instance, municipal bonds in your IRA. If I did that, you might go, hey, we got to talk, right? So what we do is we'll take the very inefficient stuff, and let's go back to the doctor call. So we look up the wife's IRA, and what she had in her IRA were global REITs and long-term treasuries. And you saw the numbers on those. She'd made like 15 and 17%, right? But the poor husband's IRA, and he's out just working his fingers to the bone. He's got nothing but developed international stocks that have made exactly nothing for the past year. And so he's going, well, my wife made 17, I made nothing, what's up? But what's up is we look at the family as a whole, and what we're trying to do, it goes back to the same thing that we're always trying to do. Where are you guys as a family now? Where are you trying to go? And how do we develop an asset allocation that's going to give you the return that you want, the highest return that we can get within your risk tolerance, and minimize that risk and minimize the cost and the tax. And so by going in here and placing tax inefficient stuff like big dividend paying REITs, or really you think about REITs, they get all their money from rental income, which is ordinary income. It's taxed at the highest rate in the land. We want to own that in a tax sheltered account, right? We own municipal bonds that doesn't get taxed. We want to own that in a trust account or a taxable account. Is that all making sense to you guys? But when you roll it all up and you look at our performance reports, you'll notice that it'll come in and it'll say, if you look at our performance reports, we are on task and we own that 60-40 stock bond mix, and I can see that it's diversified just like we talked about when we developed this plan, but it may not look that way when you go and looking at each individual account that you got from Schwab. It'll always be out of whack. So that's why we're doing that. It's very intentional. Now, I'm not saying we're not immune from mistakes. We do make mistakes. I covered our mistake policy before. Call us anytime you have any questions about any of that stuff, and we'll get us. But typically, it's going to be very intentional, and we're doing it to save you taxes and trading costs, by the way. Because if we have to duplicate every one of these and we do one of these rebalancing trades, that just, a client has 5 different accounts, well, that's 5 times the number of trades. Whereas if we have, just pieces in different accounts, then we can cut the trading costs, substantially. Let's put it that way. Maybe by 4/5 on the, okay, so.
Well, I was going to say the funny thing too is we go over this with him, and he's in his car, he's driving, we explain this whole deal to him, and he goes, "Oh wow, that makes sense. Okay, thanks." Click. That's all you want to know. Is quit.
I know this stuff. We've been through a lot of stuff, and it can get really complicated. Look, we know that our real job is to develop a solid strategy for you, a financial plan that'll help you make the most of your one financial life. And that can be, that can really be drawn out on a napkin that we came across. And Dennis, you want to kind of walk through what our real job is?
This is our job right here. This is all we do for you. I mean, that's about as simple as you can make it. And really, what I want to point out is this is what we're trying to do right here. This is all our goal is to make sure this happens for each and every one of you. And why I say that, you might think of when we first started working together, what are we talking about? What are your goals? When do you want it to happen? How much is it going to cost? Then we have a review meeting. Do you need more money? Do you, what's going on? If your goals changed, we have a phone call. Same exact thing. This is always what we're trying to do, because then what we're doing, if there's any changes, then we go through and look at the plan again. Do we need to make any changes to it? Is it still on track? Is this still what we should be doing? And then go, if there's any changes, then let's go change. If any investment changes need to be made, then we'll go get that done. And then you guys know things, unexpected things happen, good and bad. And so really why we bring this up is, the next steps is what we ask of you guys is, anytime anything changes, keep us updated on that. I mean, I know, we talk to you on the phone and meetings and stuff like that, but, if a goal changes or if there's something you'd like to see, I mean, even if it's not something that's happened, but maybe you're thinking of something. I'd like to, give some more money away to charity, or we're looking at this house and we're looking at one that's this price and this price. We're thinking about buying a vacation home or whatever it is.
Looking at starting a business. It's going to cost this much money. I mean, use us, to make those decisions.
And we can go through and run some what if. What if you do this one versus this one? What if you do that versus that? And we'll show you this one, it's great and keep doing what you're doing. If you go buy this more expensive one, you might have to cut back your income a little bit. So things like that. And we can help you make these decisions. But that's really what we ask is just, if something's changed, let us know, because we want to make sure your plan, back to this rebalancing and take the right amount of risk and the volatility, and whenever time frames, we want to make sure we've got enough or that we're not forced to sell quicker than we want to and the wrong time on stocks. So that's it.
I guess I just might want to close with a couple of words. Somebody showed up today that I didn't expect to show up today, so I kind of thought of something to say. I know the dream team didn't expect me to say anything, but let me tell you a little story. There's a fella that's a client, and maybe 8 or 9 years ago, he had us manage a little bit of money, like a 401k account. And then a few years later, he said, "Why don't you take over this account? And you're doing a good job." And then he came to me at one point and he said, "You know what? I'm always going to manage this one account over here. This is my play account. But I'm going to get rid of all these other advisors. I want to move everything else over to you and your team." He looked me in the eye and he said, "Do not let me down." He said, "Do not let me down. And I promise you guys, we will never let you down. We will always do our best. I can't tell you that it's going to be great, but I can tell you that we'll always tell you the plain, unvarnished truth all the time in support of your financial goals and your objectives." So thanks for being here.
Thanks, guys.